Hey traders, happy Sunday. This is Ron Haidt at Market Tamer. Hope you're having a fantastic weekend. As always, nothing in this presentation shall constitute a recommendation to buy or sell any security. Trading stocks and options involves risk, and specific financial issues should always be addressed with your financial advisor. We'll kick off here with the IWM. This is a daily chart of the Russell 2000 ETF, the small caps. And we saw another open and then close the lows of the day on a pickup in volume. In doing so, it also closed below the orange line, which is the 50-day SMA, which is an institutional moving average. We haven't been below that since April, but the volume is starting to get a little bigger. And if you look going back to really the end of June, the down days now are starting to be bigger than the up days. Down days are indicative of red bars, the black bars are the up days. And we can visibly see here how this is picking up, and we cannot get through that 170 area. You know, if you think back to Tuesday, I highlighted as bearish engulfing near a double top, arguably a triple top. Now we have the same thing. It looks a little tired at this point. I would want to set alerts at 170. So if we get back above 170, that means we're maybe breaking out to the upside. But right now, I'm even thinking of potential bear calls right now in the IWM versus being more aggressive and getting long puts. It looks like a top could be in now on IWM. For how long, I have no idea. No one ever does. But it's until we start seeing bigger up volume and getting above 170. So again, it looks like a top might be in here in the near term. If we look at the MDY, which are the mid caps, we'll zoom in here. There's the previous high in June, July, trying to get up there and can't. Volume picked up a little bit on Friday, but it was still sub 1 million shares. We're barely below the 50-day. I would put alerts probably up there around 365. We break out, that's bullish. Otherwise, it might be a top in here too. But when you compare the MDY to the IWM, the IWM looks, a lot more top heavy, if you will. That the buying is running out of some steam right now. Now, if we take a look at the diamonds, the DIA, not much of a down day on Friday, just hanging in there. This is still bullish. The SPY, if I zoom in here, yes, we're below the 5-day, but it's still bullish overall. So SPY is arguably the strongest right now in the way it's acting over really since the beginning of this month. But what about the Qs? They were down on Friday. They gapped up a little bit, rolled over, volume picked up. It's not quite as bad as the IWM, but we are starting to see more red bars come in here. And if I start looking at other tech stocks like Amazon, Google, Netflix, Facebook, Twitter, you're going to start to see that they also are starting to look a little tired. So just heads up here, I would say there's definitely a yellow flag being waved right now in tech land. So let's go explore that. Let's take a look at Amazon. We gapped up, closed near the lows of the day, but we still finished higher than the previous day's close, which is why it's a black candle and not a red candle. But there was a lot of selling off those highs today. On the day-to-day trend, this is bullish. We're above the 20-day EMA in red. We're still setting higher highs and higher lows, but just be careful right now with the way overall tech is looking. Here's Google, bearish engulfing. So we had the gap up, we pushed higher, and now bearish engulfing below the 5-day. This is also making the Nasdaq look a little tired. How about Netflix? And just a couple days ago, we used Netflix as a protective put example, right? We finished near the highs of the day after the gap down. We've rolled over. We have not closed above the blue line yet. So if I had protective puts here on Netflix, I'd still want to keep them because there's no signs that a bottom is in here. And if I zoom out, the line I just deleted was this, right around that 40-ish area. That would be the next level of support just because there's two highs here, but otherwise you start coming down towards the 200-day moving average in purple. How about Facebook? We gapped up, finished at the lows of the day, finished down on the day. Facebook still looks like it's going to come down and test that ballpark 170 area, almost $5 lower. Tesla, this thing is just really unpredictable right now. There's all kinds of reports out there, and I keep saying it, but Musk himself is just having issues with what he's tweeting about, and there's now questions of whether he could be removed from the board or not and all that good stuff. All I can say is I might start thinking about treating Tesla like a biotech stock, where there could be explosions in either direction. Earnings is coming up, as you can see, on August 1st. That's later this week. after the market closes. Anything could happen here if they divulge that cash is less than they thought or whatever, or maybe more cars are being made. This could go anywhere. If I was still bullish on Tesla, at the very least, I'd walk into that earnings report with a married put. Maybe consider going out like 90 days right now, buy a little extra time to see how this stock starts to settle down. I did have a question on ORC, this particular stock, which is Orchid Island. I've never looked at this one. There was 2.3 million shares. It sold off hard, got all the way down to the 50-day. It was down at $7.50 or so a share, finished up at $8.12. That is a big difference. That would be like a $75 stock, rallying back up to $81. If you just add a zero here. Over the short term, it's still bullish. We came way off those lows. And the target would be a gap fill, but that's already been done. So that means the next target would be probably up here before the avalanche of selling started. So the next target is sub 9. And then last but not least is Twitter. I just want to take a look at this one from the protective put standpoint and or the collar trade. Twitter had a really bad day on Friday. The stock closed around 42.50. Now it's at 34. So if I go into the Analyze tab and we look at Thursday's close, the stock was down $1.28 and finished essentially at 43 bucks. If we buy a $43 put right at the money, it's going to cost us 4.25. If I fast forward just one day, it's now worth $9.15. That's basically about a $5 gain. Stock drops almost 9, and the put made up 5. So you're still 4 in the hole, right? But better than a sharp stick in the eye, right? So what else could we have done? Well, to help offset that loss, we could have considered maybe a September, covered call, maybe about 10% out of the money. So 10% of 43 is about $4. So 43 and 4 is 47. Even if I came up here to 48, I could take in a little over 200 bucks. If I fast forward, it's now worth 17 cents. So we made 2 there. So the put made about 5. The call made 2. That's 6. 7. So we're up $7 in the options. We lost about 9. There's only a $2 differential here, and that could potentially be made back just by using weekly and monthly covered calls at this stage. And being down $2 versus nearly 9, to me, is a win, because the only reason we'd really look to hold stock is if we expected it to go higher, and it didn't, and that's okay. Now we can readjust our thoughts as a trader. Do we want to keep it? Do we not? But again, it beats the crap out of just holding a stock and watching it just get absolutely destroyed. In this case, by almost $9 a share. So I hope you find these examples helpful. I know some of you guys have written in, you are finding them helpful, so I brought it back again. But again, looking out to this week, to finish off the video, I'm going to give the bulls an edge, but there's definitely a yellow flag right now in tech land and small cap land. I'm going to use the S&P as the proxy. We're still above the red line, but there are warning signs out there, so keep an eye on the Russell and the Nasdaq. I wish you guys a fantastic rest of the week ahead, and I'll see you in the next video. Take good care.